Welcome to the Auto Finance Executive Roundtable, and we're going to just get started. I have a few questions to get the conversation going, and if any of you have any questions, just raise your hand, and we'll try to get a mic to you, or maybe you can just write a question on your piece of paper and hand it over. And before we get started, I'd like to have the panelists introduce themselves. Joel, we'll start with you. If you could tell us about your role and a little bit about your company as to what credit spectrum you play in, what's your average loan size or outstandings or regional focus, whatever you think is relevant for the audience to get a better understanding of and a perspective on your responses.
Sure. My name is Joel Kennedy. The name of the company is Pelican Auto Finance. We are in the deep subprime space. I'm a co-founder. I'm mainly focused in compliance and operations type, more on the servicing side, customer engagement as well. Our portfolio is about $80 million, mostly focused in the mid-Atlantic U.S.
I'm Pamela Teixeira. I'm head of asset value at Westlake Financial, and I'm responsible for asset evaluation and marketing strategy within the company. And to talk a little bit about the company, most of our business comes from independent dealers. We are increasing our presence with franchise dealers as well. In 2012, 75% of our business was part of the subprime. However, nowadays 50% is subprime and half, I would say, subprime, and the other half is in the prime business.
My name is Tommy Moore. I'm the CEO of First Investors Financial Services. First Investors has been in business for about 30 years. I'm the founder of the company. We've got about $1.7 billion in assets, 3 or 4 different business models direct to the consumer. Obviously, our indirect with factory authorized dealers, and we've got about 12 alliance partners. And then we've got a group that does nothing but portfolio acquisitions and servicing. The credit space that we play in, I would say, is really kind of the top end of subprime, bottom end of non-prime. 30 years, we've never had an unprofitable year, which is something I'm pretty proud of.
Great, thank you. We'll start with a few topics. The first is competition. The auto finance industry has been highly competitive as the demand for vehicles have been really hot, and all the lenders have been vying for that additional market share. So how would you characterize the competitive environment right now? Is it cooling off after the losses have started to go up? And what are you doing in your company to kind of stand out? Is it just price, or are there other factors that you can compete on to win that deal? So Joel, maybe we'll start with you.
Yeah, obviously, automotive lending is cyclical, and there's no escaping it. So you just really need to. I think we're kind of at a bit of a bottom point. I think there's a lot of reasons for optimism, which I spoke about in one of the earlier sessions. Veros just did a $165 million first securitization. So I think there's a lot of players that are still engaged in the capital markets and in the finance markets. So what's different? Well, I think one of the focuses for this conference is CPO. So I know there's been a lot of talk about the incoming glut of a lot of vehicles coming off a lease, and what that's going to do to used vehicle values, and what it's going to do to a company like mine that's trying to liquidate vehicles that are of much higher mileage and much older vehicle stature. So these are some of the things that I'm kind of looking at in the competitive environment. But like I said, I'm confident that we still have a lot of engagement from the capital partners and from finance companies that are still actively engaged.
Pam, would you like to expand on that?
So prime is very competitive, and it's difficult to stand out with our offering and still yield like a high return. So we are focusing on more automation and delivering a better experience for the customer and the dealer. However, on the non-prime side, Westlake has been growing, and since losses has been going up, a lot of players actually end up burning with losses. So we were able to focus on our operations, collections, remarketing, and fraud to improve our returns and keep growing even with this scenario.
Tommy, what do you think what are you doing at First Investors to stand out from the competition?
Again, we play on the top end of subprime. If I look at the competitive landscape today compared to 2006, 2007, I don't think it's near as competitive as it was back then. What we've seen in our space is really not credit going astray, contrary to everything you read in the New York Times and so forth. It's really been more pricing pressure. We've seen the banks take a step back, which were one of the main drivers of the pricing pressure, so there's been some pricing flexibility that's come back into the marketplace. What we've also seen over the past year is the captives step in a big way. It's getting to the point where, and we've seen this movie before, to where financing is selling cars, cars aren't selling cars, and we've also seen credit unions step up into the space in a big way. So we're how do we stand out? We know when to hold them, when to fold them, when to. I think the market right now is a little bit frothy with the collateral values going down. I'm also think our consumer. Middle America is not in the best shape right now. I don't think they fully recovered. And you look at the inflation numbers and so forth, so we're really focusing on affordability and so forth.
So you mentioned pricing pressure. Would you say margins are going down for you or for the industry as a whole?
No, I think they're on the upswing now. I think over the last several years, they've been on the downswing with pricing pressure from banks. Sitting where I sit, when we use the capital markets to fund ourselves, doing securitizations and so forth, I'd say they were mispricing the risk. But if I'm sitting with 0% with zero cost of funds on deposits, well, you have to relook at it. They're probably not mispricing the risk. But we've seen the banks take a pretty big step backwards, which has given some pricing pressure back to the market, or taken the price pressure off the market.
Yes, so I think in a competitive environment, it's your innovation is a must-have. What would you say in your company, Pam? Maybe you start with as to whether it's a systems, there's a process, customer experience. Where do you think Westlake stands out in terms of innovation?
I think besides automation, because we're really automated-driven company, we have a team. It's the scientist team. They are dedicated only on creating this learning machine with data we have available, alternative data, and economic data as well, to come up with a tool that will help us making decisions faster and identify trends earlier, so we can act on faster.
So you mentioned about alternative data. Is that a requirement for you in terms of your whole portfolio? Are you looking at certain segments where you think alternative data helps you? How do you really use alternative data beyond bureau data?
Well, we always try to find patterns. So we even Facebook, LinkedIn data. Those are things that we would even use to try to identify any pattern and segment our portfolio or a trend, so we can reduce our risk and losses.
So you would say, I guess, the analytics is kind of a key standpoint for you. What about you, Joel? Where do you think Pelican stands out in innovation?
Yeah, so one thing that I tend to talk about is about customer engagement and using the mobile platform to really kind of maximize your interactions with consumers. So we've seen that consumers like text messaging and they love the mobile engagement, and we rolled out a mobile app earlier this year, and the adaptation is just going much faster than I would have ever even kind of imagined. And it's a great vehicle for communication, and they can personalize it, and it's kind of fun. So, I mean, I think of like a Venmo, what is Venmo? It's just, you're just sending money from one person to another. What made it so great? Because they stuck emojis on it. There's going to be something that we're going to find ultimately within our mobile app that's going to create that coolness and that stickiness. We haven't found it just quite yet, but we will find it. I think there's a lot of possibility with innovation with that.
So you think, I guess, customer experience and customer interaction is key for you?
Yeah, I think it's, you always say you got to know your audience and you got to hit your customer at the time, in the mechanism that they want to be hit. And the mobile phone is the number one on the payment waterfall. The car comes behind it. It wasn't that way when I started back in 2009. It's changed. You have to have a mobile strategy. You have to have a mobile engagement if you want to kind of keep up, as far as I'm concerned.
Tommy?
I agree with everything they just said. Alternative data, I think, is very critical. We've completely automated the front-end piece of our business on the credit side. Alternative data, if you look at a lot of data is not being reported to the credit bureaus today, that it's very predictable. As of July, judgments and tax liens are no longer being reported, which in our space are pretty big attributes. So I think that there's a real dependency on being able to pull alternative data in and using it in your process, which we've been doing. As far as innovation, I mean, it used to be 5-minute turnaround time with warp speed. Today, they've already signed the contract and driving out in the car if you're responding then. We've partnered with a number of tech companies to eliminate friction points with the consumer. And I think that we're in the infancy stages of this. I think there's going to be a lot more of it that's going to be happening. And I don't want to be on the bleeding edge, but I don't want to fall off the back edge either. So anyway, there's a lot going on that's pretty exciting in the industry right now.
So I guess you would say there's a renewed sense of using alternative data with some of the factors not being reported to the bureaus. When you say some tax liens are not being reported, are they present in the alternative data, or is there other factors that you can look at to kind of gauge better sense of risk?
Tax liens are no longer being reported by all three bureaus. Tax liens and judgments, as of July, they vaporized, they're gone. Yes, we're using them, and you can see those things. And not only are they very predictable attributes, but both of those, you can also have your wage garnished or seized, or your checking account taken over on a judgment. I mean, they're pretty big attributes. And so it's not only that, there's an awful lot of debt that's just simply not being reported to the credit bureaus. And when you look at affordability ratios of the consumer, in order to be able, can this person afford it? Are they being put into the right vehicle? You have to take the debt into consideration. And I look at it as a breakdown in the credit system, quite frankly. I think that there is an awful lot of data, and we've collected this since 2012, that's simply not being reported to the bureaus now. They're reporting the goods. The bads are not being reported.
So consumers have been racking up auto loans like never before. Now we are at about, what, 1.2 trillion in auto loan debt. And then at the same time, we hear news about delinquencies and auto losses increasing. But the economy has been doing just fine. The unemployment rate is down to 4.1%. Why do you think losses are going up? Tommy, we'll start with you.
Okay, it's going to start with the bear first. I don't think, and it's not a 5-minute discussion, but I'll try to make it that way. I don't think the world is as good for the middle class as everyone thinks it is. I think there's, sure, you look at the unemployment numbers, they're at historical lows. But what they're not looking at is the underemployed. They're not looking at wage growth. You look at, I don't buy into the inflation numbers. You look at rents, what's going on with rents around the country. You look at healthcare costs, what's going on there. You mentioned data plans. It's now at the top of the waterfall. 10 years ago, 8 years ago, that was not the case. I think that the middle class is in a really tough place right now and having a very difficult time. I've spoke to a lot of CEOs that have pulled back, and they're still seeing their delinquencies go up. What's causing it? Is it the economy? Something going on in the economy? I don't think there's a smoking gun, but I don't think the state of the consumer is as well as, I don't think the middle class has recovered the way the top end has recovered after the Great Recession.
So would you say, are you looking at your portfolio management strategies or origination criteria to update your expectations given where the trends are going?
Of course, and I mean, we live in data, and we have for 30 years, and it's one of the things that we do is do deep dives into trying to figure out the common threads or what's going on. There's also another piece of the innovation beyond just the front end piece as well, which is innovation on the back end piece, in being able to make ease of making a payment. I'm not going to answer that phone. They just set it down. So you have to have multiple avenues for the consumer to be able to speak with you or to communicate with you beyond just a telephone call. So there's we're looking at how we improve the back end piece of our business, what we need to do on the front end. We're looking at affordability, very different than what we have in the past. Again, a data plan, that's going to be the first priority. That wasn't the case in the past. So I don't think there's just one thing. I think you're having to look at several things. And I look at the rising delinquencies, at least in my space. I can't speak to the deep subprime space, but in my space, it really wasn't a credit go astray in this industry. It was nothing back like in 2006, 2007, what you saw with waiving income and all that kind of stuff. So something else is going on, and it's not happening to one or two companies. It's happening across the industry. And we're trying to figure it out.
And Joel, what about subprime? Are you tightening credit criteria?
Yeah, I think some of the things that we've done is to just, you have to make some line of scrimmage changes. And so, one thing that I was vocal about earlier this year was we predicated my business off using the starter interrupt device and basically made it our mantra. Every car is going to have this on it, and we're going to use it. And what we found over time was that that there's actually other means that are as effective as disabling somebody's vehicle. There's a whole other compliance and regulatory world that came out in last year as well. That's anybody who's using this device, you got to make sure you have your head on straight. You have a policy. It's actually practiced, and you're monitoring it. But an example is field chase. Field chase is as effective as disabling a customer's vehicle in terms of getting a result, which is a promise to pay. It's as effective. So you just have to be nimble, and you have to be able to make some changes and say, we don't have this tool anymore. We're going to go over here, and we're going to use a different tool to get the job done.
And so, going from that to maybe compliance, would you say your compliance costs are going up or down?
Compliance costs, I would imagine across the industry, should definitely be going up. My compliance program, I'm always going to have an appetite to grow it and to make it more sophisticated. So we started off with making sure we had a good compliance management system and that it was tested by a third party. Not an audit, but a review. Then we got into the world of this last year, I need the full spectrum of risk management built out in terms of risk management testing and understanding my risks, that they're sized, and I know what the impact would be if I'm not covered properly, and my control effectiveness. That's the second big piece. The third big piece is vendor management. So, I mean, how many folks here are sending out entire teams, understand who the risky vendors are, and are actually putting feet on the street and going to that vendor? It's a very costly exercise to engage in. We're a very small business. I'll admit that we're not anywhere near where we need to be. So from that standpoint, I have just an insatiable appetite for growing compliance program, but we're relatively small, and I have a small department, and we're doing the best that we can on that accord.
Tommy, are you happy to grow your compliance department as well?
Well, in this industry, if you're not growing your compliance department or your costs isn't going up, you're not doing what you should be doing. Whether I like the laws or don't like the laws, it's not my job to opine on that. My job is to make sure we follow them, and we take it very serious. And yes, our costs have gone up over the past several years as we have moved from a non-regulated institution to a regulated institution.
And so let's move on to maybe capital funding, and Joel, you touched on it a little bit. Tommy, what would you say is capital availability increasing, or you know, securitizations, new issuance is coming down a little bit? What are your avenues for funding, and you know, how do you see that capital availability for you, for the industry as a whole, and for your company?
Yeah, for our company, I've really never had an issue with capital. I've always been able to get the capital I needed. We get great execution in the capital markets. I think we did the first securitization that was ever done subprime in 1992 and have been a regular issuer since then. We also have very strong bank relationships. 08, 09, we never lost liquidity. So we've got great resources there as well. And then the third piece of it, from our standpoint, when you start a company with no money, you develop a culture of watching every penny. And that culture 30 years later is still there. And we have pretty much always been cash flow positive. So we don't really have to go out and raise sub-debt and stuff like that just to cover general operating expenses. So we have access to the capital markets. We need to buy portfolios. We have partners that we can bring in, and just never had a problem raising capital.
Okay, we'll move on to a topic that's near and dear to my heart, collateral values. So Black Book Retention Index early in the year was down 6% year over year. Now it's more like 2%. So there's been more volatility, and you know, recently with hurricanes we saw some huge improvement in valuations. What do you think about you know, in terms of the risk from collateral? Is that top of mind? Where do you see that in your company and your strategies? Pam?
Yeah, so we have been trying to can you repeat again?
That's okay, take your time.
Can you repeat the question again?
Well, from a collateral risk perspective, do you think that risk is increasing? Is there increased focus in your company on collateral risk?
Yes, especially because what we notice is that it's not sufficient to just use the average values that we currently have. So we have been implementing a way to look at the vehicle's unique attributes. So right now we have a bunch of vehicles that were damaged because of the flood, because of the hurricane. So we have to be able to identify how those values, it will be impacted by that. And so we are inputting that all in how we buy the deals, so we are able to control the risk for that.
And Joel, what would you say? Are you using collateral data more in your portfolio management?
It's possible. It'd probably be a better question for for Scott, who runs our risk. But I do know we've continued to face headwinds in the disposition market. It doesn't seem to ever get any easier. It just gets harder. I'm always looking for kind of new ways to hedge the real issue from my standpoint, which is the consumer kind of income and mechanical risk issues. So, you know, I would love for every customer to have gap insurance and a service contract that's good and all these things, but you know, they don't always have access to money to make it through some of the bumpy periods. And you know, that's where they have to make some tough decisions, and sometimes we have to, you know, we have to be on the receiving end of that.
Right. So I think one thing in collateral values, you know, there is an assumption of about, let's say, 12 to 15,000 miles being driven every year. But then you have, you know, some customers in your portfolio who might be, you know, taking the car for ride sharing and maybe putting 50, 60,000 miles a year. Tommy, how is the industry addressing that risk?
I can't speak to the industry. And speak to us. We don't allow commercial use of a vehicle. Obviously, after you buy the car, if you want to be a Lyft or an Uber driver, I don't have much control over that, but I'm not a big fan of financing them if I know it going in.
So is that in your contract? How are you addressing it? I mean, how do you hold them accountable for it?
Well, I can't hold anyone accountable for it. If they decide, if they buy a new car and then a year later they decide they want to go be an Uber driver, I don't have any control over that. I do have control going into the contract, and it's one of the questions that we ask when we do a customer interview. So we don't allow commercial, and that's what it is. You're using your car for commercial purposes, and we don't allow it. I can't do anything about it once it's occurred, after the contract has occurred, but going in, we have the checks and balances to try to sort it out.
How about you, Pamela? Is there something that you're looking at for ride-sharing use? Or?
Actually, I don't have a clear answer about that.
Yeah. Joel?
I would just anecdotally think that the ride sharing would create a better income equation, less inflexibility for job loss, cover the edges. But interestingly enough, I think I've heard it about 3 or 4 times in the past year that customers were voluntarily surrendering their vehicles because they were going to go do a ride-sharing thing where they were getting financed on a vehicle through Uber or Lyft. Not a lot, though. Like I said, I've only heard it 3 or 4 times, but it was interesting enough that it kind of bubbled up.
So I think we just have 1 minute left here. What's your prediction on origination volume in 2018? Is that going to go up, stay the same, or go down? Joel, we'll start with you and then come down. Wow.
Rub the magic ball. I unless something changes structurally in the economy, I'm inclined to agree with my other panelists here probably that I don't see any reason to be thinking that the bulls are going to run, but like I said, all the supporting actors within the industry themselves, I'm not seeing any breakdowns in those.
Yeah, I would agree.
Tommy?
Yeah, I agree.
Okay. Well, with that, that's all, folks. We've run out of time, and please join me in thanking the expert panelists who have given us great insights today.